This is a meeting of the TARP Financial Services and Bailouts of Public and Private Programs. The hearing is entitled The State and Municipal Debt, the Coming Crisis. At the beginning of this hearing, as I do with all subcommittee hearings, I read the mission statement of the Oversight and Government Reform Committee. So that's what I'll do now. The Oversight Committee mission statement. We exist to secure two fundamental principles. First, Americans have a right to know that the money Washington takes from them is well spent. And second, Americans deserve an efficient, effective government that works for them. Our duty on the Oversight and Government Reform Committee is to protect these rights. Our solemn responsibility is to hold government accountable to taxpayers, because taxpayers have a right to know what they get from their government. We will work tirelessly in partnership with citizen watchdogs to deliver the facts to the American people and bring genuine reform to the Federal bureaucracy. This is the mission statement of the Oversight and Government Reform Committee. With that, I'll recognize myself for 5 minutes for an opening statement. This hearing is the second installment of the subcommittee's efforts to examine the causes and severity of fiscal problems facing states and municipalities. Today, we'll explore the magnitude and the growing budget liability of states and municipalities and its origins. From years of unwise fiscal policy to reckless management and collusion between elected officials and the public sector unions, the crisis has emerged as a great expense to the American people. It also has an impact on our markets. It also has an impact on people's savings, especially for retirement. Leading economists have already labeled 2012 as the state's most difficult budget year on record. 44 states and the District of Columbia are now projecting aggregate budget shortfalls totaling $125 billion this year alone, and it only gets worse each year. Even more threatening is the $3.2 trillion in unfunded state pension liabilities and another $383 billion liability for local governments. To be sure, the budget crunch is closely associated with the larger economic stresses facing the country. But years of unchecked spending and overly generous benefits have taken their toll. There are $3 trillion in municipal bonds outstanding across the country, and many state and municipal governments face the real possibility of defaulting on their debt. Ultimately, this hearing is about two things. First is the real debt burden facing states and, may I restate? First, what is the real debt burden facing states and municipalities? And second, what must be done to mitigate the immediate crisis and put these governments back on solvent fiscal paths? But let me restate for the record what I said in Part 1 of this hearing back on February 9th. The era of the bailout is over. Let me repeat, taxpayer bailouts are not on the table. The past 2.5 years of wasteful spending and irresponsible policy under the guise of economic stimulus and emergency economic stabilization have emptied the Treasury of every thin penny. And even if Washington had more money to spread around, a bailout would only serve to delay the coming day of judgment, pushing our children and grandchildren, pushing on them the burden of paying for our irresponsible spending. There must be other options, and this series of hearings is about assessing those options. First, understanding the problem and assessing our options to move forward. Some states are making bold efforts at reform. In 2009, for instance, the State of Utah experienced such massive losses due to the market collapse that taxpayer contributions to government workers' pensions would have to rise to $420 million annually to keep them afloat. Senator Dan Lillenquist, however, successfully championed a plan to reform that will allow the state to remain solvent and enjoy greater budget flexibility. Senator Lillenquist, thank you for being here today. I look forward to your comments. At the executive level, governors like Chris Christie of New Jersey and John Kasich of Ohio have begun to push piece-by-piece legislations to reform their pension plans gradually, while still others, like the State of Wisconsin, for instance, have become the proving grounds for the future. Last week, Governor Scott Walker made good on his promise to Wisconsin voters to overhaul the entire structure of public sector unions in the state. That is a bit of controversy, of course. Even the President has commented upon that. Governor Walker's legislation has met with great resistance, but fomenting political chaos will not help to serve or fix this fiscal crisis. The question before us today, they require careful, sober consideration, and it's critical and critically important that Congress examine the state and municipal fiscal crisis and to judiciously evaluate reasonable policy options. Today's witnesses are all experts in that field, and the subcommittee will give them an attentive ear. And with that, I yield for 5 minutes to the ranking member, Mr. Quigley of Illinois.
Thank you, Mr. Chairman. And before I begin, I ask unanimous consent to have a statement from the National Education Association be entered into the record.
Without objection.
Thank you. Mr. Chairman, I would like to thank you for convening today's hearing, the second hearing on state and municipal debt. I also like to thank our 5 witnesses for contributing their time and expertise. In fiscal year 2012, 44 states are projected to have a budget deficit of at least 5%. Although troubling, this is a short-term fiscal problem that has more to do with the current economic downturn than with underfunded pension programs. Once the economy gets going, state revenues will go up and budget deficits will shrink. In the long term, however, we have an accounting problem unique to 6 to 8 states, among them Illinois, California, Ohio, and New Jersey. For years, under both Republican and Democratic leadership, these states have grossly underfunded their pension programs. No one has to tell me there is a problem. I am from Illinois. Illinois is one of the worst examples, with a $162 billion unfunded liability. Its pension system is less than 50% underfunded. This level of underfunding is reflected in Illinois' bond rating. In the last 5 years, its bond rating has taken a nosedive. Before it raised taxes, an outcome nobody wanted, its bonds were considered only slightly less risky than Iraq's. Its bond rating is still poor, and that means it is much more expensive for Illinois to borrow money. According to Lawrence Massall of the Civic Federation, bad bond ratings were costing Illinois taxpayers $551 million extra per year in interest payments. States like these need to take common sense steps to shore up their pension systems. Reform is important not only to protect taxpayers, but also to protect the beneficiaries of public sector pensions. These pension systems provide retirement security for millions of government workers, and we have a responsibility to ensure that we are not shortchanging them. Pension reform should restore long-term solvency to pension systems so that workers can depend on a steady retirement income. We can keep defined benefit plans while taking reasonable steps like increasing worker contributions and realigning retirement age, COLAs, and term of service. In some states like Illinois, pension reform will have to go farther than in others. What we have to avoid is a one-size-fits-all approach that doesn't distinguish between the bad apples and the good. And we also have to remember that the onus must be on state governments to reform themselves. One model for troubled states might be the recent series of pension reforms in Massachusetts. Under Governor Deval Patrick, Massachusetts has passed several pension reform packages. Just earlier this year, in January, the Governor proposed 8 reforms that would improve the long-term sustainability of the state's pension system. Officials have estimated that these reforms will save Massachusetts billions of dollars over the next 30 years. They are also an important step toward a higher bond rating and lower borrowing cost. On February 8th, the bond buyer reported that Standard & Poor's revised Massachusetts' outlook to positive from stable based on strong management practices. Of course, every state and municipality is different, and pension reform would have to be tailored to each specific situation. Still, the Massachusetts example demonstrates that pension reform can be achieved not only increases bond ratings, but decreases borrowing costs. That also protects workers and guarantees them a steady retirement income. I thank the Chairman, and I yield back.
I thank the ranking member, and I certainly appreciate the panel for being here today. Members will have 7 days to submit opening statements for the record, and we'll recognize the panel now. I'll introduce the whole panel, then we'll begin with you, Senator Lillenquist, to give your opening statement. The Honorable Dan Lillenquist is a member of the Utah State Senate. Mr. Robert Curter, I'm sorry, I'm bouncing around, sorry, is the Managing Director for U.S. State and Regional Ratings at Moody's. Mr. Dean Baker is co-director of the Center for Economic and Policy Research. Thank you, Mr. Baker. Dr. Baker, I'm sorry. Ms. Robin Prunty is the team leader for state ratings at Standard & Poor's. And Mr. Andrew Biggs is a resident scholar at the American Enterprise Institute for Public Policy Research. It is a policy of the committee that all witnesses be sworn in before they testify. So if you'll please rise and raise your right hand. Do you solemnly swear or affirm that the testimony you are about to give will be the truth, the whole truth, and nothing but the truth? All right. You may be seated. Let the record reflect that all the witnesses answered in the affirmative. Now, in order for us to have time for discussion, we do have votes on the floor in less than an hour. So if you could keep your comments to 5 minutes, the clock will register for you, as you can see. With 1 minute remaining, it moves from green to yellow. That means hurry on up and finish. And any time that you don't use is really a gift. So if you can summarize your statements, we'll also let you offer your statements, full statements, for the record. And with that, Senator Lillenquist, you're recognized for 5 minutes.
Thank you, Chairman McHenry, Ranking Member Quigley, and members of the committee. It's an honor to be with you today. If there's an upside of an economic downturn, it's that taxpayers throughout the United States are waking up to the massive liabilities incurred by state and local governments. In particular, financial commitments made to public employees are driving policy debates throughout this country. Defined benefit pensions are at the heart of these policy debates, as policymakers wrestle with the approximately $3 trillion unfunded pension liabilities. For years, public employee pension plans have largely been exempted from taxpayer scrutiny because of the long-term nature of pension commitments and the assumption that today's market losses will be made up by tomorrow's gains. However, the market crash of 2008 revealed just how much market risk taxpayers are bearing to guarantee pension benefits for public employees. Utah's pension system is a case in point. If I might, I'd like to spend a couple of minutes discussing the situation in Utah. Going into 2008, Utah's public employees' pension systems were over 100% funded. Utah has always paid the full required actuarial contribution to its pension systems and has not raised retirement benefits for over 20 years. Utah's retirement system had been, and still is, recognized as one of the best-run pension systems in the country. However, market losses in 2008 blew a 30% hole in Utah's pension fund, opening up a $6.5 billion unfunded liability. To put this number in perspective for the State of Utah, our constitutional debt limit is set at 1.5% of the total assessed value of real property in the State. That value is currently $4.4 billion, and we've borrowed $3.3 billion of that $4.4 billion, or approximately 75%. Adding Utah's official debt to Utah's newly recognized unfunded pension liabilities, Utah's total debt is $9.8 billion, which is 223% of Utah's constitutional debt limit. In the fall of 2009, Utah's Joint Retirement Independent Entities Sub-Appropriations Committee, of which I am the Senate co-chair, requested an in-depth actuarial review of Utah's pension liabilities. For the first time in our State, we asked our actuaries, instead of looking in the rearview mirror, to look forward for 40 years and assess a variety of scenarios to give us a better understanding of where we're going. The report highlighted some troubling facts. First, we realized that Utah, and I would say any other State, if you look forward, cannot grow its way out of these pension problems. We would have to average in Utah 13% returns year over year for 20 years to grow out of the 2008 losses. If Utah's pension system averages its assumed 7 3/4 rate of return and we do nothing else, Utah's pension system will be bankrupt by approximately 2040. Second, we realized Utah must dramatically increase contributions to the pension systems required to compensate for the 2008 losses. And these contributions will increase and continue to increase over the coming years and stay there for our amortization period, which is 25 years. Our total contributions will equate to approximately 10% of Utah's general and education funds for 25 years to pay off 1 year's worth of losses. Finally, the study from our actuaries showed that Utah cannot absorb another year like 2008. For example, if we hit a 6% return over the next 25 years, we are bankrupt now as a state and don't know it, because we are hoping that we can get the market returns we need to meet the commitments we've made to our employees. Last year, the Utah Legislature acted aggressively to cap its existing pension liabilities. We closed our defined benefit pension plans to new enrollees, created a new retirement system for new public employees hired after July 1st, 2011. The crux of our pension reforms are that the State will no longer have an open-ended guarantee to its public employees. Instead, we are saying affirmatively we will put a certain amount towards retirement, and that's what you get. Now, employees have the option to choose between a 401k-style plan and also a defined benefit pension hybrid plan, but they are on the hook for the market risk. It is our hope as the State of Utah, as we've tried to manage our liabilities and risk, that other states will follow suit. It is now time to act and make sure we are containing these liabilities so we can move forward as a state and as a country. Thank you.
Ms. Prunty.
Mr. Chairman, Mr. Ranking Member, members of the committee, good afternoon. My name is Robin Prunty, and I'm a Managing Director in Standard & Poor's Rating Services business. I'm an analytical manager in charge of the State Ratings Group. Standard & Poor's is a credit rating agency, and as such conducts analysis and forms forward-looking opinions about the creditworthiness of debt and debt issuers, including, among others, states and municipalities. And I'm pleased to appear before you today. Standard & Poor's believes that the difficulties faced by states and municipalities will give rise to very difficult budget and policy decisions, but not defaults for R-rated universe in the overwhelming majority of cases. This is because state and municipal debt obligations are secured either by a specific pledge of the government's full taxing authority or dedicated taxes, user revenues, or fees, and there's often a priority status for debt relative to other obligations. Because states, and in many cases local governments, are required to balance their budgets rather than finance budget deficits solely through debt issuance, they are annually making choices to align revenues and expenditures. These actions, along with the Federal stimulus funding, contributed to relative credit stability for most U.S. public finance issuers. While credit downgrades have increased over the last 2 years, and we expect there could be further credit deterioration in 2011, in the majority of cases, we believe that general obligation and other types of direct debts of state and local governments we rate will continue to be retired as scheduled. Over the past 25 years, there have been 42 defaults for non-housing issues in U.S. public finance at Standard & Poor's. There has been one observed default by a state in more than 100 years. Although the number of defaults has been, relatively speaking, low, we do believe that securities issued by rated governments can still face meaningful default risk. Because of the slow progress of the recovery from the recession, S&P believes that the continued flat or slow revenue growth trends for state and local governments may add to strain on budgets and overall liquidity, especially in the short term as Federal stimulus funds end. In addition, we believe that pensions and other post-employment benefit obligations represent material long-term risks to governments and have long been factored into our criteria for rating state and local governments. Recent investment performance of the assets in most pension trust funds is well below historic trends and negative in many cases, which has contributed to weakened pension funding levels. Governments that are not funding their annual required contributions risk the most significant changes in their budget capacity in the future. Such concerns have given rise to pension reform movements in certain states, and we expect that this will continue. While we believe that liabilities to public employees represent genuine long-term pressures on government credit quality, they generally are not immediately competing for most governments' capacity to fund their debt service or meet other priority payment obligations. In general, we believe that the worst-case scenarios regarding pensions will likely occur only if governments are unable or unwilling to use their powers of adjustment. Notwithstanding the difficult policy choices facing state and local governments, S&P continues to expect that most issuers that we rate will continue to retain their strong capacity and willingness to meet their debt obligations. Moreover, there is little incentive for them to allow their debt obligations to default. This is in part because we believe that a defaulted debt service payment would likely result in a loss of access to the capital markets, which has been a significant source of funding for capital and infrastructure projects for both state and local governments. We have observed that governments have made many improvements to their budget structure, reserve policies, and debt management during prior periods of budget stress, which in our view has generally enhanced their ability to manage through downturns. Reconciliation of structural revenue and expenditure misalignments may not be achieved in one fiscal year, but reform efforts are underway and for many governments, and we expect that this will continue through 2011. Effective financial management will be key to addressing these challenges, and governments have strong powers of adjustment. If governments do not manage or make adjustments and instead rely heavily on debt and other one-time solutions in the hope that economic growth will balance their budgets, we believe that they could be setting themselves up for greater hardship in the near term. Throughout difficult economic periods, including during and after this most recent recession, we have generally seen on the part of governments what we consider to be a very strong commitment to their debt obligations, which for us has been an important credit consideration over time. While there are vulnerabilities in the public finance sector, our expectation is that the threat of default is generally not widespread among state and municipal issuers that we rate. I thank you very much for the opportunity to participate in this hearing and would be happy to answer questions that you may have.
Thank you, Ms. Prunty. That was probably the most amazing use of time. Well done. Thank you. Dr. Baker.
Thank you, Chairman McHenry and Ranking Member Quigley. I want to thank, in particular, Representative Quigley. I'm also from Illinois, and my mother is one of those public employees who's dependent on the pensions there, so I appreciate your concern. I want to make three main points in my comments today. First off, that the financial strain facing state and local governments is first and foremost originates in Washington, and perhaps I should say Wall Street. It's a problem of the economy, and that's where most of the difficulties stem from. Secondly, that the problems that our pension funds face are manageable. And the third point is that the pension fund accounting is for the most part reasonable, that they're looking at expected returns on their pension funds, requiring pension funds to use a risk-free rate of return in assessing their funds could lead to higher cost and possibly ending defined benefit plans altogether, which I would argue would mean higher costs for taxpayers. First point, the fact that the problems originate in Washington should be fairly straightforward. We're 3 years, 2 months into a recession. The unemployment rate is still 4.5 percentage points higher than it was prior to the downturn. If we compare that to the last serious recession, 81-82, we already were back at the pre-recession level of unemployment. It's reasonable to expect state and local governments to prepare for downturns, but this is an extraordinary one without precedence. This was due to mismanagement here in Washington at the Federal Reserve Board, irresponsibility on Wall Street. This was not your run-of-the-mill recession. And just an idea of how much difference that makes, we're currently 6% below potential GDP. If we assume that state revenues were 6% higher, a good first approximation, most of these states would have no problems at all balancing their budget. In the case of Wisconsin, which of course has been in the news lately, they would have $4 billion in additional revenue over their 2-year horizon, fully making up their shortfall before even taking account the savings on expenditures for programs like unemployment insurance, TANF, and other expenditures that have increased during the downturn. So this is first and foremost a problem that originates in Washington. Not to say that all governments were responsible, but certainly the problems were enormously worsened by the severity of the downturn. The second point, oftentimes we scare people by using big numbers. The pension liabilities, however estimated, are very big numbers. But if we calculate them relative to the size of the future economy over a 30-year period, the normal horizon, we're looking at a shortfall that, by my calculations, is a little more than 0.2% of GDP. That's hardly trivial. But if we compare that, say, to the increase in defense spending from 2000 to 2011, that was 1.7 percentage points of GDP. So the amount of additional revenue, whether through tax increases or reduction of other spending, is about 1/8 as much as we found to increase our defense budget between 2000 and the present. Not to say that's trivial, but it's very much a manageable sum. The last point I'll make is that I would say that the pension funds are using appropriate accounting They're using expected values. And I will say that I've been a critic of their accounting in years past. In the 90s, in the 2000s, when you had very high price-to-earnings ratios, they were making assumptions about future stock returns that were clearly unrealistic, and I said that quite openly at the time. Now that you've had a big fall in the stock market, going forward, given current price-to-earnings ratios and given growth projections from the Congressional Budget Office and other major forecasters, their assumptions on rates of return are very realistic. The alternative, if we were to insist that pension funds use a risk-free rate of return, we would have two stories we could tell. One is that they continue to invest in equities, but they assume a risk-free rate of return. This would, in effect, require pre-funding. This would be very perverse policy. It would mean more taxes or less spending in the current to have savings in the future. We might think that prudent in some sense, but I don't know if anyone has recommended pre-funding schools, pre-funding fire departments. That's not ordinarily the way we expect our governments to function. The alternative is to say, okay, they would just invest in bonds and get the lower risk-free rate of return. If we did that, pension funds would be more costly to state and local governments, which would mean a higher burden to taxpayers. The final possibility is we could end up eliminating them altogether, which, as we know, some states have done, some local governments have done. This, again, is a cost to taxpayers if we think this through carefully. Defined benefit pensions are something that workers value greatly. The fact is that state and local governments can endure timing risk with the stock market because they're essentially infinitely lived individual entities. Individuals, of course, have finite lives. For individuals, it's a very, very big risk. By virtue of taking that risk, we're able to get either better employees for the same wages or the same employees for lower wages. That's a benefit that workers get in exchange for other compensation. If state and local governments no longer take advantage of their indifference to risk, they end up losing that benefit, and that will cost taxpayers more money. Thank you.
Thank you, Dr. Baker. Mr. Kurter?
Thank you. Thank you. Good afternoon, Mr. Chairman, Congressman Quigley, and members of the subcommittee. My name is Robert Kurter. I'm a Managing Director in the U.S. Public Finance Group at Moody's Investor Service. I want to thank you for inviting Moody's to share our views as part of today's hearings. My comments will focus on the credit risk of public finance bonds that are rated by Moody's. A significant number of public finance bonds are not rated by Moody's or any other rating agency. Because unrated issuers and bonds may have quite different risk characteristics than rated ones, my comments should not be generalized to the entire universe of public finance bonds. I also want to be clear that Moody's opinions in this sector speak only to the likelihood that a government-issued bond is likely to be paid in full and on a timely basis. While we take into account all of an issuer's major financial obligations, we do so in order to assess the likelihood that an issuer can and is willing to meet its payment obligations to bond investors. This means that when we use the term default, we are referring specifically to the failure to make payments to bondholders and not a failure to fulfill any other obligations a state or local government may have, such as utility payments, salaries due to employees, or pension liabilities. I'll turn now to our views on the sector. All of us here today know that state and local governments are experiencing unprecedented financial strain. This is reflected in the negative outlooks Moody's has had on all major subsectors in this market. For state and local governments, our negative views are driven by four main factors. First, the overall economy is still fragile, even though it is recovering. Second, state and local governments are facing increased liabilities, such as pension and health care costs. Many commentators have recently focused on pension liabilities. Moody's has long factored these liabilities into our analysis and opinions. Growing unfunded pension obligations are creating challenges for these issuers, and we are monitoring the situation closely. We have taken and will continue to take rating actions where we believe an issuer's credit profile warrants it. Third, lingering fiscal pressures have required state and local governments to make severe budget cuts, use budget reserves, and pursue other non-recurring solutions to solve their budget gaps. And finally, revenue sources are strained due to persistent high unemployment, sagging real estate prices, which lead to drags on taxes. Let me focus now specifically on the condition of the U.S. states. Most states are facing challenges with respect to both their liabilities and revenues. The recovery is still fragile, unemployment is very high, and it is uncertain when sustained revenue growth will take hold. That said, Moody's does not see bondholder debt as a source of credit strain for most states. This is because annual bond debt service costs remain a relatively small share of overall expenditures. In addition, most states do not face refinancing or material rollover risks. We believe that we could see a few more states turn to deficit financings to fund operating expenses or restructurings to produce budget savings in 2011. But we expect those states to be the exception rather than the rule. For these reasons, and because of the strong incentives states have to pay their bond debt, we believe it is very unlikely that any states will default on their bond obligations in the next 12 to 18 months. In the local government sector rated by Moody's, we see unprecedented financial strain for the reasons I mentioned earlier. Further, the states can shift some costs to the local government level, which is likely to exacerbate the challenges there. However, we also expect that a majority of the individual local governments will make the tough decisions and the budget cuts needed to continue to make timely payments on their bonds. We do not expect widespread defaults by rated state and local governments. However, there have been situations in the past where the risk of default seemed imminent, even though it was ultimately averted. We saw this, for example, in Harrisburg, Pennsylvania. We expect there will be some additional cases of severe credit stress going forward. In summary, there is substantial credit pressure on the U.S. public finance sector today. Over the next 12 to 18 months, we believe it is unlikely that any state will default on its obligations to bond investors, and we believe the increase in bond defaults among local governments will be relatively small. Thank you again for inviting me to testify on this important matter, and I look forward to answering your questions.
Thank you, Mr. Kurter. Dr. Biggs.
Chairman McHenry, Ranking Member Quigley, and members of the committee, thank you for offering me the opportunity to testify with regard to state and municipal finances and the role that public pension financing may play. It is my hope that state and local finances will avoid a severe disruption. Like a plane buffeted by turbulence, they will survive so long as they had sufficient altitude before the event. My greatest concern is not so much for this recession as the next one, which inevitably will come. If we enter that one in precarious financial position, state and local governments may not have sufficient room to maneuver. The rising costs of public sector pensions, while not the main driver of state and local financial problems, have gained increasing prominence in recent months. My work on public pension financing argues that if we wish to strengthen state and local government finances, we need an accurate assessment of the size of pension liabilities and the steps that will and won't help the governments reduce them. Current pension accounting methods unequivocally fail on this front. To be clear, the so-called market valuation critique of pension financing is not a criticism of the average returns that plans project for their investments. It does not say, for instance, that pension funds will yield 7% on average rather than the 8% average they claim. Rather, it says that because this 8% is a risky return, it is inappropriate to use that interest rate in valuing benefit liabilities that are guaranteed by state law or constitutions. Pension's current practice of discounting guaranteed liabilities using returns on risky assets runs counter to economic theory, the practice of financial markets, and the accounting standards imposed on private sector pension plans. As the Vice Chairman of the Federal Reserve put it, quote, "While economists are famous for disagreeing with each other on virtually every other conceivable issue, when it comes to this one there is no professional disagreement. The only appropriate way to calculate the present value of a very low-risk liability is to use a very low-risk discount rate." End quote. Most economists believe that since pension benefits are guaranteed by governments, it is appropriate to discount them using interest rates derived from other government-guaranteed investments, namely Treasury bonds. Using an appropriate discount rate, current unfunded pension liabilities are not $500 billion as claimed, but over $3 trillion. Violating this rule, as public pension accounting does, leads to nonsensical results. For instance, public pensions could erase all their reported deficits and even generate a surplus if only they were to shift all their investments to stocks and assume a 10% rate of return. Note that plans' actual benefit liabilities would be the same and the market value of their assets would be the same. But by adopting a more aggressive funding strategy and ignoring the risks of that strategy, they could magically generate $500 billion at the stroke of a pen. If this seems to make no sense, it is because it does make no sense. But even today, after the financial crisis and the market meltdown, many public sector pensions are effectively doubling down on risk. Having already doubled the share of their assets going to stocks since the mid-1980s, public sector pensions are now the largest single investor in hedge funds and are also moving into private equity. There is no coherent funding strategy that would use these assets to fund fixed guaranteed benefit liabilities. This is particularly so when you note that the public sector pensions operate under a standard called interperiod equity, which dictates that every year a plan should fully fund the benefits earned in that year and not pass on liabilities to future taxpayers. But when you fund a guaranteed benefit using highly risky assets, it is obvious that you are passing significant contingent liabilities onto the future generations. And the more risk you take, the larger these liabilities are. Using discount rates that economists deem appropriate, public pension unfunded liabilities are somewhere over $3 trillion. The only way to reduce these unfunded liabilities would be to actually fund them. Most states currently devote 3 to 4% of their budgets to pension funding. Using more accurate accounting, that would rise to over 10%. In some states, significantly more so. Simply taking more investment risk won't do the trick, nor should it. We face difficult choices, but on one thing we should be clear. It is more important to get the numbers right before you have a crisis, when you still have time to do something about it, than to wait until a crisis has hit. It would be a sad irony if, even as we recover from a financial crisis driven by lax accounting and excessive risk-taking, that we lurched into a new one driven by the same causes. Thank you very much.
Certainly appreciate your testimony, and I'll recognize myself for 5 minutes. Mr. Kurtter, in your testimony, you affirm that combining both debt and pension metrics will improve transparency for investors. Can you please name specific measures that states can adopt to enhance transparency?
Thank you, Mr. Chairman. We published a report recently combining debt and pension metrics into one metric for purposes of providing increased transparency to the marketplace for purposes of evaluating credit risk. We did that because we were trying to conform with practices in other business lines, the way corporations are looked at in hospitals. Our goal is improved transparency for the investors who rely on our ratings.
What specifically could states do? I mean, in terms of public policy, what can we do to enhance disclosures for investors?
Yeah, we don't advise or make recommendations.
Okay, then if that's your answer, that's your answer. Ms. Prunty, would you answer the same question? Will you turn on your microphone?
Yes, thank you. We have looked at pension liabilities as part of our criteria for many decades, and I think that the challenge when you look at public plans is that the current governmental accounting standards allow for a range of actuarial assumptions when they're calculating those liabilities, so it is very difficult to do an apples-to-apples comparison among states and among local governments as well. So, we do report those liabilities and have reported those alongside debt and give them equal weighting when we're evaluating the debt and liability profile. But I think that some of the variability in the actuarial assumptions that are allowed definitely make it challenging to do that kind of comparison.
Would uniform disclosures assist in credit rating and transparency for investors?
Well, I think that there's current efforts underway with the Governmental Accounting Standards Board to look at that issue, and we're obviously watching that closely. There are a lot of unique features as you go from plan to plan. They're not uniform plans, government by government, so I think that the one-size-fits-all solution is probably a little bit challenging there, but certainly a little more uniformity would make it easier to make comparisons across governments.
Mr. Kurtter? Would uniformity assist?
Yes, we are in favor of more uniformity and consistency and transparency across the marketplace in terms of reporting this information.
Okay, thank you. In a comparison to the corporate bond market to the muni bond market, is there more disclosure in the corporate bond market than in the muni bond market, Ms. Prunty?
Well, when we're assigning ratings, we are generally relying on the information provided by issuers, and we, based on our criteria, are assuming that.
Well, actually, if you don't want to answer the question, it's fine. I don't have much time. Is there more disclosure and more transparency in the corporate bond market than the municipal bond market? Yes or no? Like, which one?
Yeah, I've been in public finance my entire tenure at S&P, so I'm not familiar with the corporate.
Mr. Kurter?
Generally disclosure or pension disclosure, Mr. Chairman?
Both.
Both.
Or either. Whatever you'd like to answer. I'm just trying to get an answer from you guys.
Yeah.
And this is a beef. I got to be honest with you. This is a beef with the credit rating agencies, is you guys talk around the problem and actually not address it. This is sort of the frustration that many of us have, and I think the marketplace has with this. Mr. Carter?
Yes. In corporate disclosure, generally, there's interim financial reporting and other types of more timely reporting. Municipal disclosure, the audits are typically, often late, and there is no interim financial reporting. That said, I think it's important to recognize that in the public finance marketplace, there are many resources of publicly available information that are not available in the corporate world. Budget information, revenue reporting, things that are publicly available as a consequence of the budgeting process.
Sure. In terms of what has happened in Ohio, according to the municipal bond strategist, upon the recent passage of Ohio State union reform legislation, the cost of borrowing reflected by the yield of the state's long-term general obligation bonds fell by a meaningful percentage, and dropped the cost of borrowing for Ohio post-passage of this union reform legislation, basically the collective bargaining agreement. Mr. Carter, can you touch on this? Would you be willing to touch on that?
The existence or non-existence of collective bargaining is not in and of itself determinative of budget balance or the likelihood that an entity will acquire large unfunded liabilities or large post-retirement liabilities. From our perspective, we look at the bottom line. It's not how the budget is, it's whether the budget is balanced rather than how the budget is balanced.
But it had a meaningful effect in the marketplace. Though it didn't create change the rating, it did change the rate that people were paying, the state was paying.
I don't track the pricing, so I trust that that's correct.
Okay, thank you. With that, I yield, I recognize Mr. Quigley for 5 minutes.
Thank you, Mr. Chairman. Dr. Baker, you're a little more optimistic on the overall picture than some, and on the overall picture, that's probably accurate. Wouldn't you concede that for 6 to 8 states in the pension issue, it is far more acute a problem and far more dramatic action has to be taken?
Well, thank you, Ranking Member Quigley. I'm usually not known for my optimism, but you certainly do have several states, the ones you had mentioned on that list, that clearly have more serious problems. We have a number of states that, had we not gone into the downturn, their pensions would be pretty much fully funded. We had other states that faced problems even prior to the downturn, and certainly the situation was made considerably worse by the downturn. And as you know, in your own state, Illinois, of course, they did have a substantial tax increase, in part to deal with those problems. I suspect you will see comparable actions in other states.
But is that enough? I mean, even Illinois is still borrowing a significant amount of money to meet those obligations. Are you suggesting, with all due respect, that it can all be made up for with additional revenue?
Well, I don't mean to tell the states how they should deal with their shortfalls, but I will say one thing that is front and center is the state of the national economy. If it were the case that we were somewhere near full employment today, Illinois and every other state would see both a much better overall budget situation, and as well its pensions would likely look better, both because there would be more money flowing into it, regular money flowing into it, and then on top of that I would anticipate the stock market moving back towards more normal levels.
Well, if we believe in collective bargaining, we should also believe in collectively solving the problems. I guess what I'm trying to get you to is that it's not just the economy or additional revenues. There has to be some meeting in the middle. I mean, at least some of these pensions, you would agree, have been a little too generous, a little too out of sync with actuarials in terms of when people start collecting, how long they collect, how long they pay in, the COLAs that are involved.
Well, a couple of points I'd make on that. Pensions are part of an overall compensation package, and there have been a number of studies. We've done some at my center. A number of other organizations around the country, academics, have done studies looking at public sector compensation in general. The conclusion of the bulk of these studies, I know Dr. Biggs has opposite conclusions, but the conclusion of the bulk of these studies is that public sector workers are paid a little less, taking into account their pension commitments than private sector workers adjusted for education. Now, having said that, are there cases where I think pensions are inappropriate, where maybe workers are allowed to retire too early, where they're perhaps structured inappropriately? It's common for pensions to be based on just the last 3 years, sometimes just the last 1 year. I wouldn't do it that way. But again, I'm not setting the laws for State pensions.
I agree. We're both in that situation. Ms. Prunty and Mr. Kurter, you seem fairly confident that we're not in for a major default in the next year or so. But stranger things have happened when the experts haven't picked up. The issue that I'm most concerned with is the impact on the market as a whole, even just the bond market. Is there a contagion factor if a major State had a major default?
Thank you. We do, our current rating would suggest that we, don't see a default for Illinois, and actually their bondholder.
Or any State.
Yeah, or any State. Illinois has actually, over the last year, during last legislative session, put some protections in to ensure that there was sufficient special funds on hand in order to cover future years' debt service obligations, both short and long term, and have made some adjustments there in order to, focus on that. So I think that.
But the question still stands. Given a possibility in this country of a major default, is there a contagion factor, or is this all isolated in terms of how you rate funds?
I think defaults historically, if you look at, New York City back in the 70s, there was a significant focus on the market and the impact there, and I think that's why you see so many oversight mechanisms across States to prevent local governments from being in a default situation for exactly that reason, that there would be concern that there would be implications for the broader market.
Mr. Kurter, quickly.
Yes, thank you. The markets clearly are very jittery right now. We don't believe there will be major State defaults. We don't believe that there will be more than a few small rated defaults among local governments. But clearly the markets are jittery, and any kind of a significant default would add to the nervousness of an already jittery market.
Thank you.
Gentleman's time expired. Ms. Burkle for 5 minutes.
Thank you, Mr. Chairman, and thank you to our panelists for being here today. My district is in upstate New York, so if you'll indulge me for my 5 minutes, I'd like to talk about the state of New York, and in particular because it is one of those 44 states that Mr. Chairman spoke of in his opening remarks. Dr. Biggs, I'd like to just direct my question to you and to Mr. Kurter, and then if anyone else would like to comment on it. In 1975, New York City found itself in a crisis and had to make a decision between paying its debt or paying its employees. And as you know, they paid their debt down. My question is, do you foresee New York State being in facing such a choice within the next 5 years? And if you could comment on how dire you believe the situation is in New York at the present time.
Well, I know a little bit about New York State. My father's from upstate New York near Schenectady, so I spend a bit of time up there. I would not claim to be an expert on New York State finances. Certainly, in the recent history has not been encouraging there. New York State's pensions have been better funded than in many states of the country, but that, when you use honest accounting, that's being the top of a very bad heap. But still, the other costs the State government has to deal with are pretty significant. I have not followed closely enough the efforts of Governor Cuomo there to try to rein in some of the costs and to bring balance to the budget. If those are successful, certainly New York will be in better shape. I think because of New York's reliance on tax revenue from Wall Street, which is highly cyclical, they have a risk factor there that some other states may not have. So certainly I'm hopeful. I'm more hopeful now than I was 6 months ago, but New York State has a long way to go.
Thank you. Mr. Kurter.
Yes. Our ratings really speak to whether or not we expect the State to make good on its bond payments in full and on time. That said, of course, the State has had very difficult problems, as all States are facing tremendous problems of managing their revenue and spending. Our view is that the States have revenue and spending problems, but not really debt problems, because even in New York, their debt service is a relatively small portion of their overall spending. Right now, of course, because revenue is short, payments to the retirement system and all other expenses are competing with each other for scarce dollars, and the State is having to make difficult choices about balancing their budget within the constraints of weaker revenue.
Thank you,
just
Senator.
quickly add to that, again, just to remind the committee that first and foremost, the state of the economy will be the most important factor to determining the ability of New York and every other state to meet its obligations.
Thank you, Dr. Baker. Senator?
You know, you asked the question whether or not New York is in a situation where they need to pay their debt or pay their employees. Utah is in that situation right now. As we ramp into 75% increases in our employer contribution for pension systems, that is going to pay for these losses. That's 10% of our general fund that will not be available for wages or health care benefits for our employees. We fund things in this order in our state, and I think most states are similar. We fund pension benefits first, health benefits second, and whatever change is left over goes to wage. And our wages in the state have fallen behind as we've struggled to keep up with pension and health care costs. And so as we looked at this, our reforms, we started calling it maybe euphemistically the Wage Liberation Act, because we said, look, you can't have a set bucket of money and having your benefits eat more and more of that bucket of money. You have no money left for wage. So we've struggled to get the 24-year-old, you know, at the start of his career, because he or she is looking for wage, and benefits are less important, and we struggle to recruit as a state. We think by affirmatively saying, and generous, our legislation says you get 10% towards retirement, 10% of your wage. If you're public safety or fire, you get 12%. And so it's a generous amount, but it's set, and that's all we're doing. So hopefully over time, we can repair wages for our employees, which by our data in the State of Utah, their actual wage is lower because we are making this choice: do you pay this debt or do you pay the employees? And we're struggling with that right now as a state.
Thank you. I yield back my time.
Mr. Welch for 5 minutes.
Thank you, Mr. Chairman. Senator, congratulations on your success in making some progress in dealing with this in Utah. You've got to give us the magic potion so we can make some progress here. You know, one of the things we are struggling with is our own deficit, and the new majority is, in my view, rightly focusing on that. But there's consequences to some of the policy decisions we make. And I just want to ask, I'll start with Dr. Baker, what is the impact on the states in their ability to address, among other things, this underfunding of the pension, if we have $100 billion in cuts that include substantial revenues that the states have been depending on? Is there an impact?
Well, I'd certainly expect there to be an impact. To some extent, these are revenues, as you say, that be committed to the states. But I think probably the bigger impact is that there have been a number of estimates. Mark Zandi at Moody's and Goldman Sachs came up with estimates that this could lead to losses many 700,000 to 800,000 jobs. This means more people unemployed, slower economic growth, less tax revenue to the states. I think that actually is likely to be the bigger impact due to the impact on the economy than sort of direct impact in terms of cutting money to state governments.
Okay, thank you. Mr. Kertner, how about you? And again, these are policy choices we have to make. There's not endless money. We here in Congress have got to bring us back to fiscal balance, but I also think we have to be clear-eyed about the impact of some of these cuts when it's revenue that goes to the states, and then how that impacts their ability to deal with their own fiscal problems. Do you have a comment on that question?
States are beginning to face the fiscal dilemmas that they're challenged with right now. They're making very difficult spending and revenue cuts, touching programs that in prior years were off limits. These are tough choices elected officials have to make. And with regard to pension obligations, they're also beginning to address some of those issues, too, by increasing employee and employer contributions, as well as addressing the benefit side of the equation.
Okay, Ms. Prunty, how about you?
Yeah, I think it's fair to say that the budget climate is still very difficult for states, and if there were any reductions in revenue sources, be it federal or other tax sources, it would be add additional difficulty to the current budget challenges, particularly because Medicaid is a very large portion of state spending, and that's the primary federal flow of revenue to states. So, yes.
Thank you. And Dr. Biggs, I think you made a very compelling point in terms of the investment models and what's realistic. You can't have a pie-in-the-sky kind of projection. But on the other hand, is it equally questionable as to whether there should be the so-called risk-free model that imposes what historically I think is a much lower rate of return, where there are consequences to state budgets if you have a so-called risk-free model where you can give yourself the perhaps satisfaction that you are, quote, guaranteed to have that return, but on the other hand there is a consequence with respect to how much then has to be put in to fund it, and it may be more.
Sure. Well, I think it's important to repeat that the use of a riskless or risk-adjusted discount rate is the way you value your liability. It doesn't restrict the plan if it wishes to invest in equities or invest in more risky assets, and the plan will benefit from those investments if they pan out. If they invest in stocks and the stocks generate higher returns, then they actually have more assets on hand than they otherwise would have. The objection is to essentially assume that those assets will generate 8% returns going forward without taking any risk into account. If you go back to the 1980s, up to the mid-1980s.
Let me just get clarification, because I think this is quite important. If you have a riskless model where you're saying it has to be the T-bill rate, let's say, where there's some guarantee, we hope the Federal Government's good for it, that can have a depressing impact on the ability of a state to meet many of its other legitimate obligations, including what Senator was talking about, trying to bring up the wage scale.
Sure. But if you value your liabilities correctly, the liability is what it is. How you fund a liability is an entirely distinct question from what the liability is. Plans today, state pensions, generally take an aggressive funding strategy, which means they invest in stocks, in hedge funds, things like that. The higher expected return means they can make a lower contribution today, and people like that. It leaves more money for other things. But because the benefit is guaranteed, it means a higher contingent liability on future taxpayers. Now, that's inconsistent with the standards that GASB lays out that says you should try to fully fund your benefits as they accrue and not pass contingent liabilities. But what we're finding out today, again, going back to the mid-1980s, before then you had a high level of funding into state pensions, but conservative investments that go into them. They would invest mostly in bonds and things like that. That meant you had to put a lot of money away, but you didn't have a large contingent liability. Since then, they went more aggressively into stocks, which essentially cut their funding levels in half. And for many years, you had good times. The stocks returned well. They increased benefits. They had funding holidays. Today, we're seeing the flip side of that strategy. So you can't take an aggressive, risky strategy and expect that you're never going to have to deal with the downside. And that's currently what we have.
The gentleman's time has expired. Mr. Meehan of Pennsylvania for 5 minutes.
Thank you, Mr. Chairman. And excuse me for a second. Thank you, Mr. Chairman, and thank you for each of the panelists for your articulation of a lot of details on a very, very challenging issue, certainly for those who struggle at the local level. And I often think about these things in the context of municipalities, not just the states where there's a greater capacity to handle these, but a lot of local obligations that have been undertaken for everything from funding local economic development to other kinds of programs. And I'm thinking about the implications that are going to be sort of bleeding down, particularly as we aren't able to predict yet what states are actually going to be doing with their budgets. But the implication is that much of it is going to be pushed down to the local level as well. I think, Ms. Prunty and Mr. Kurter, you discussed this issue, which I don't clearly understand, which is the role of accounting in municipal finance, which may be different from what we do with a publicly traded company. Can you, and the fact that we may be understating the risk because of the method of accounting. Can you explain to me what the difference is between municipal accounting and accounting that's done, say, for a corporation and their, their tax filing?
Yeah, I think on the Governmental Accounting Standards Board side, there is a different governments, I think there's a recognition that they are different from corporations because they are going concerns, and there's a unlikely that they will be out of business going forward. So the Governmental Accounting Standards Board does allow a different set of assumptions to be used for public pension accounting, and that has been the case. There is significant discussion underway at the Governmental Accounting Standards Boards to look at that and determine if that is still appropriate given market performance of the last decade. But I think that the accounting differential really recognizes the fundamental difference between governments and corporations.
Well, is it exclusive to pensions, or does it involve other kinds of general obligation bonds as well?
Well, the Governmental Accounting Standards Board also, covers the annual financial statements or financial audits that governments provide. So there is a differential in accounting standard there, also recognizing some of the differences between corporations and governments.
But if it's understated, and that was the testimony, I believe it was you or Mr. Carter, was there somebody that testified today that local, there's a sort of an understatement of the problem? Dr. Biggs, you did. Would you then answer my question?
The standards used by the Governmental Accounting Standards Board, or GASB, allow states or municipalities to discount their liabilities at the expected rate of return of any assets they've set aside to fund their liabilities. So if they think their assets are going to return 8%, they can discount the liability at that. That applies mostly to pensions. It would apply in some limited cases to retiree health care. Some states pre-fund their health care obligations, most don't. So in the private sector, a private sector pension plan could discount its pension liabilities at the rate of return or the yield on corporate bonds, which is currently around 5.5%. So the effect of the differences in the discount rates is really very, very large between the private sector and the public sector.
Okay. Well, thank you for that explanation. I just have one remaining question. Mr. Kerner, let me ask you this one. In my review for this hearing, there was a discussion about the fact that the Federal Reserve looks as if they're going to decrease their participation in purchases within the bond market. Do you have any sense as to what impact that's going to have on the interest rates and a prediction about how high those interest rates may go?
Yes, Mr. Congressman, that's really something that's outside my area. I'm a state and local government analyst, and I don't really have an opinion on these kind of larger macro issues.
Okay. Is there anybody on the panel that does have a feeling on that issue?
Well, the consensus, if you look at the Congressional Budget Office and really just about every other forecaster out there, is that interest rates will head upward. They're at extraordinarily low levels today, and assuming that we do see some sort of economic recovery, it's reasonable to expect that they'll get to more normal levels.
Thank you.
And with that, I yield the full committee ranking member, Mr. Cummings, 5 minutes.
Thank you very much, Mr. Chairman. And I want to thank our witnesses for your testimony. Dr. Baker, one of my concerns, and having been now in state legislature for 15 years and been here on the Hill for 15 years, you see a lot of times folks trying to deal with a problem as if that problem is going to last forever. And they deal with it, and then things get better. And I'm just, when I listen to a lot of the discussion, I'm worried about folks who, when the economy comes back, we try to make all, these changes, and it'll be hard to reverse it. You follow me? And is that one of your concerns too?
Absolutely. And again, I was on the other side of this argument a few years back, because I did feel that given price-to-earnings ratios in the stock market in the 90s, in particular when we had the bubble, that pension funds, both on the private and public side, were being hugely over-optimistic. Now we have a serious downturn. Much of the pension fund shortfall likely will go away when we get future year valuations, because, of course, the market has recovered much of its lost ground. I'm not saying it's going to go away 100%, but we're looking in many cases at funding periods that were very near the trough of the market. Now, there's averaging, so it's a little more complicated than that, but we're in many cases looking at funding periods that were near the trough of the market. The market has recovered much of its value. I don't have a crystal ball, so I can't tell you it will recover all of its value, but it's almost certainly going to be the case. They will look better simply from that recovery. And again, if we had the economy back on its feet, if we were back near 5% unemployment, we'd be looking at a much better situation in general for state and local governments. So the idea that we're going to be in perpetual crisis, I can't rule that out, but I think that's going to be more determined by the situation of the macroeconomy than the finances of state and local governments themselves.
Well, that leads me to my next question. Probably the most poignant example of how politicians use pensions and public employees as their scapegoat is the battle that has transpired in Wisconsin on this issue. As a February 22, 2011 Huffington Post article explains, it says, while Governor Scott Walker has painted a dire picture of his state's pension obligations, Wisconsin's pension fund for public employees is among the nation's strongest, according to a report by the nonpartisan Pew Center. The Pew report issued last year concluded that Wisconsin is a national leader in managing its long-term liabilities for both pension and retiree health care, end of quote. Dr. Baker, according to that same article, Governor Walker used his state's pension obligations to argue for a need to revoke collective bargaining rights of state employees. And I'm just wondering if you have an opinion whether such a drastic step was necessary, or was that an example of a scare tactic that you've discussed in your report, February 2011, entitled The Origins and Severity of Public Pension Crisis?
Well, I won't claim to be an expert on either Wisconsin's funding or Governor Scott's motives, but I will say from what I know of its funding, it's very close to fully funded. They've been very responsible. And I'll point out that, again, just to be as clear as I can here, pension is part of the overall compensation. There have been analyses specifically of Wisconsin's compensation packages. Jeff Keefe at Rutgers University looked at it and found that public sector workers receive somewhat less total compensation than comparably educated, experienced private sector employees. If you are to cut the pensions in some way, you could no doubt in the short term save some money, but workers expect comparable pay. If you're reducing public sector compensation, you could either say, well, maybe we won't get as good workers in the future, or alternatively, maybe you'll have to make that up in other pay. And again, the defined benefit is very important. Workers value that certainty. And again, this gets back to this issue Andrew was raising, that states can bear the risk. If you have a downturn and there's 2, 3, 4 years where the market's down, where things look bad, states can get through that risk as long as they've in general been responsible. If you or I retire and the stock market's down, we're out of luck. There's nothing we could do about that. So by virtue of taking that risk, that's a very big benefit for workers that they're willing to give up other compensation for. We lose that if we end defined benefit plans.
One of the things that, when you talk to workers, particularly ones in my district, they tell me that when they were voting for during negotiations, union negotiations, that they took less pay because they were worried about the benefits when they retired.
It's very common. Public sector workers have lower pay by almost every measure than private sector workers, straight wages, but they have somewhat better pensions and health care benefits.
Thank you, Mr. Chairman.
Gentleman's time has expired, and with that, I recognize the full committee chairman, Mr. Issa of California.
Thank you, Mr. Chairman. Thank you for holding this important hearing. Dr. Biggs, we have a constant debate, it seems, on public and private sector activities, union, non-union. The ranking member went on quite a bit, acting as though it's scapegoats. Don't we have basically a difference between unionized private sector workers and public workers, particularly in that In the private sector, a unionized worker is in Social Security. Well, in the public sector, at all the State levels, virtually, they're in a system that has their high pay opted out of Social Security and often Medicare, which means they're out of a system and into their own system, which is not fully paid for. And as I think Dr. Baker made very clear, they have this safety net, which is current overseers, the elected officials and or their representatives, can make a deal that ultimately they know cannot be kept in the future without unrealistic expectations of growth in their bonds. Typically in California, they were assuming a growth that you could not find in any index, but you could find it for a short time in PERS and STIRS. Would you like to give us a little insight into that part of the problem we're dealing with on these pensions?
Well, this, I think, is an important issue, because one question of how you resolve some of these pension financing issues comes down to your perceptions of how well or how poorly paid public sector employees are. You're right that many public sector employees don't participate in Social Security, and that's sometimes pointed out as if they're losing something in that regard. And I don't want to downplay the important protections that Social Security provides, but as a general deal, public sector pensions are a far better deal for them. Social Security would pay them, on average, a rate of return around 2% on their contributions. Under the typical public sector pension, they're effectively guaranteed a rate of return of around 8%. Compound that over your full career, and it's an enormous difference. You also tend to get in the State and local sector retiree health care, which can be very generous, and often that's not included in the private sector. Congressman Cummings was just mentioning employees in Wisconsin. I know Milwaukee teachers, for instance, receive retiree health care that's worth around 20% of their pay. The sort of pay studies we've heard about today saying that State and local employees are underpaid, it doesn't include retiree health care. It also tends to undercount the pension benefits they get. So we want to get a good feel for where things stand. We have to compete for workers with the private sector. If you're in any low level of government, you don't want to underpay people, but it takes careful analysis to be able to tell whether they're being fairly paid or not. One, I guess, to touch on your last point, the assumptions that go into the pension financing, things like this, I've focused on the assumed rate of return, and that's the most important one. There are many other things that can be jimmied around. Illinois had some problems where they would cut benefits for workers that haven't even been hired yet and book those savings today. There's been examples in Washington State where their actuary said, you have to better account for the longer work lives of people, and the board said, no, we're not going to do it.
And I'm going to cut you off. I apologize. But it's a good train of thought, and certainly in San Diego we have a scandal where that has been well codified in criminal prosecutions. Dr. Baker, I saw you startled when I talked about the unrealistic expectations of the growth in PERS and STIRS and so on. Now, I heard you say earlier with the ranking member that, well, the markets have come back. But isn't it true that if you were broadly invested, you, in fact, over the last 3 years had effectively net zero? And net zero is 24% compounded, less than the anticipated amount that these contributions were based on. Can you sit here today saying that anyone on this side of the aisle should have confidence in these retirement plans if they assume 8% growth rather than, let's just say, inflation plus 1 or 2?
I don't think there's been anyone who's been more critical of overly optimistic returns in the stock market than I am, and I base that on price-to-earnings ratios. They were very high in the 90s. They were still somewhat high in the last decade. They have fallen a great deal. Future returns depend on current price-to-earnings ratios. Now that the price-to-earnings ratio is considerably lower, if you look out over a 20, 30-year horizon, then yes, I could look to your side of the aisle and say, yes, I think those returns are very reasonable, and I've done the arithmetic. Okay.
Well, I hope you're right. Let's do another half of this. Dr. Biggs, back to you for a second. We have historically low interest rates today. We have a huge ballooning Federal deficit, but my own State of California and many others have built up a lot of debt. What happens if we return to, if you will, somewhere between where we are today and where we were in the 70s? What happens to both the Federal and the State's ability to meet pension obligations?
The Federal budget and, to a degree, State budgets have benefited from the fact that our financing crisis, our budget problems have coincided with significant financial problems overseas, which has pushed capital from foreign countries into the U.S., and that's helped keep our interest rates low. So we've been very sort of advantaged by virtue of that. If interest rates start rising back to normal levels, or if they go even further, if markets are not convinced of our ability to get on top of our deficits, then all of this process starts cascading, and it happens much sooner than we'd otherwise anticipate. The history of financial crises, whether you're talking about currency crises, banking crises, is they can continue going on normal, but when they happen very quickly. So I think it's very good, and we're very lucky to have low interest rates today. We should not be complacent because of that.
Thank you. Yield back.
Thank you, Mr. Chairman. We'll now recognize Ms. Maloney for 5 minutes.
First of all, I want to thank the Chairman for holding this and Ranking Member. And we're going to the floor shortly on a budget vote to continuing resolution. And in the budget proposals that have come forward for fiscal year 2012, practically every 42 states have proposed to spend less on education and health care than they spent in 2008 after inflation. And states are proposing these cuts despite the fact that the costs associated with their services will be higher. So given that backdrop, I'd like to ask Mr. Baker, why is it important at this time not to cut Federal funding for State and local governments?
Well, again, I would say there's two reasons here. One, perhaps the more important, is the macroeconomic reason that at this point the Federal deficit is supporting the economy. If we were to radically roll back the Federal deficit in 2011, we would see less demand. I don't know of any story that I could tell whereby if we cut back spending, lay off public employees, we're going to see retail stores, hospitals, whoever it might be, go out and hire more workers. I don't know a story of the economy that works like that, at least not when you're in the middle of a downturn. So the macroeconomic picture is very important. The other part of the story is obviously many of these programs have the character of investment. We're talking about education. If our kids don't get adequate education because we have 1, 2, 3 years of economic slump, they're not going to be able to make that up. If we don't, some of the cuts are in regulatory programs like the Securities and Exchange Commission. I would think people would be very sensitive to that, recognizing that we clearly had problems of inadequate regulation. We were talking about fraud in the public sector, or at least questionable accounting. There clearly was a serious rash of that in the private sector as well. I would think that Congress would be very sensitive to that. So I think we could pay a big price for it.
Well, isn't it true that proposed GOP cuts to Federal funding for State and local governments will force some States to impose higher taxes and to cut vital public services, actions that will hinder economic growth? Could you comment on that?
Well, most States in the country are facing serious budget shortfalls, and they are making cutbacks in a wide range of areas, and many of them are raising taxes as well. One could argue as to how vital those are, but clearly they are making important cutbacks, and I think even the governors that have been aggressive in supporting those cutbacks, I think regret many of them in the sense that they feel they are cutting back services that have real merit. And again, this is not the time, I would think, that you'd want to see cutbacks in programs that say provide health care for the poor, because there are more poor now, and it's very hard to argue that they could simply go out and get a job when we have close to 25 million people unemployed or underemployed.
And Mr. Baker, how will State and local governments balance their budgets without this much-needed Federal funding? Many States have budget gaps that are huge, including my own State, including the great State of California and others. So how in the world are they going to balance their budgets?
Well, nearly every State has requirements that they balance the budget, and there's always some room around that. But in most States, this will mean serious cutbacks in spending and or increase in taxes, which, again, this is not the sort of thing you want in the middle of a downturn. If we were in a situation where the economy were at normal levels of output, we're operating near 5% unemployment, you could say, okay, fine, the private sector will pick up the gap. But I don't think you credibly can tell that story given where the economy is today.
Well, I want to thank you for your testimony and just conclude by saying that State and local governments have eliminated 426,000 jobs since August 2008, and State budget cuts have eliminated additional jobs in the private sector. And in fact, at least 13 of 42 States who have released budget proposals for fiscal year 2012 have proposed layoffs and cuts in pay and benefits for public workers, and 8 states have proposed measures such as extending expiring tax surcharges, repealing tax credits or deductions, and broadening the base of some taxes and raising rates. And we have been called for a vote on that sort of depressing note. Thank you all for your testimony and for being here today. Thank you.
Thank you for yielding back. And with that, I recognize Mr. Ross for 5 minutes.
Thank you, Mr. Chairman. I'll try to be brief. You know, I'm trying to get my hands around this, and it appears as though even though we've had a reduction in workforces both federally, statewide, and on municipalities, there still exists an unfunded mandate out there, or an unfunded liability out there, excuse me, with regard to the defined pension plans. And Ms. Prunty, what I'm trying to understand is at some point, as a financial rating organization, you have to look at these pension plans and say it's too good to be true. I mean, you have to look at the investments that they're making in order to fund these, correct?
When we are analyzing pension, we do include pension in our review. It's part of our criteria and has been. We look at all of the underlying assumptions. We look at the liabilities, and it is factored into our rating. You'll see a differential. For instance, Utah is a AAA-rated state, and they have very proactively managed those liabilities and looked at their assumptions. And so you do see us factoring in
but they've looked at it and made adjustments from moving away from defined benefit plans. Is that correct?
That's part of the solution in Utah, but that's not universal across governments. Most of the pension plans do remain defined benefit.
In your statement, you say, in general, we believe worst-case scenarios regarding pensions will likely occur only if governments are unwilling or unable or unwilling to use their powers of adjustment. What would you recommend to be their powers of adjustment in order to avoid the worst-case scenarios?
Yeah, I don't think we would have a recommendation on what the power of adjustment is, but I think that history has shown that they have the ability to either manage the liability side of the equation or increase contributions or make other adjustments to the overall program and plan. So those are really policy choices that each individual state or local government will make.
Moving from a defined benefit plan to a contribution plan would be a step in the right direction. Would you not agree?
I think that we would say that those are, again, policy decisions that each government is going to make on, and we'll look at the overall impact on the liabilities.
But from your perspective, from your financial rating perspective, it would be more advantageous to a better rating if it was a contribution plan.
I think proactively managing the liability is certainly very positive, and making a strong commitment to funding the pensions has historically been consistent with a high rating level.
Mr. Curtin, I want to go to you for just one quick second, because you also are in the financial rating business now. If, as the title of today's hearing implies, bailouts on public and private programs, if there were ever to be a bailout, would that not be an assumption then that a financial rating service would have to take into consideration when giving a rating? I mean, once the precedent is set?
Our ratings don't assume that the Federal Government will bail out states. We do assume that the
let's assume that it is done, and that a bailout is actually done.
What we do consider is that the Federal Government has always, and by law, assumes the cost of emergency response in the event of natural disasters and other man-made events, and we do build that into our ratings. Since the role of the Federal Government in providing bailout, if a state were to need assistance, is uncertain, we don't embed that in our ratings because we don't have enough precedent to reliably know that investors could depend on that.
But it would seem to me, though, that once the precedent is set, then it would have to be considered as a potential assumption in making your ratings.
Considered, I mean, a precedent is situationally based, and may be relative to particular circumstances that may not be something we could rely on in the future.
Dr. Biggs, one thing real quickly. Mr. Curter points out that we do not expect any states to default on their bond obligations in the next 12 to 18 months. Do you agree or disagree with that statement, and why?
I wouldn't want to overstate my competence in this area, because it really depends on state-by-state knowledge, and it's also extremely difficult to predict low probability events. If we had defaults every year, we'd have very good models for knowing what leads to a default. At this point, they're so infrequent, it's hard to say. So I think I would agree, but it's certainly not something I'd be complacent about.
Okay. And Senator, last question. Given the bad results of many revenue bond projects, should such highly risky projects benefit from tax exemption?
Pardon me?
On municipal bonds. Should we continue to have tax-exempt municipal bonds, or should Congress come into play and say, hey, wait a second, these things are so risky, there's such a high rate of default, we're incentivizing the sale of them with tax exemption. Should we as Congress step back and say, you know what, maybe we should readdress the tax-exempt status of these things?
You know, I think that's a good question. I think the challenge we have more with our municipalities is having them overextend themselves because of the free ability of credit, and we're addressing that in our state ourselves, trying to make sure that our cities aren't overextending themselves, and we end up being the catch-all for them. So that's something to consider.
Thank you.
The gentleman's time has expired, and with that, I'm going to recognize the Vice Chair, Mr. Genta from New Hampshire, for 2 minutes, and then Mr. Walsh for 3.5 or 4 minutes, depending on the time for the votes on the floor. Mr. Genta.
Thank you, Mr. Chairman. Thank you all for being here. I'll be very brief because we do have to go over to vote. But a question for Dr. Baker. First of all, do you feel, generally speaking, that the Federal Government should be backing, the loans that States are asking for and demanding for their borrowing?
I'm afraid I'm not sure exactly which loans you're referring to.
Well, the Build America Bonds program.
Oh, I'm sorry. I think a program like that's a reasonable program. You know, could one construct different contours toward it? Sure, but I think given the where we are in the economy, I think it does make sense for the Federal Government to encourage States to engage in infrastructure spending, stimulus of different types. We do need to boost the economy.
And for the edification of the committee, what's your opinion as to where the Federal Government gets that money from?
Well, given that we're in a downturn right now, that would mean borrowing. I don't think there's any doubt about it. If you were to raise taxes, it would be self-defeating.
Okay, so the Federal Government is borrowing money to give to States so they could borrow to pay whatever obligations they have. I hope that they're not doing it for, I would accept that it would be capital-based projects and things of that nature, but I have seen some States borrow to pay, their operating costs, which is obviously not a good thing to do, but I've seen it. I guess my question would be, this Build America Bonds program is expiring, correct?
That's right.
Does that have a negative or a positive effect on, from a rating agency perspective, for the States that are using that have used that program?
Did you want me to answer that question?
Sure, yeah.
If they reduce their borrowing, if they're no longer borrowing because the program's not there, I'd imagine it would be pretty much neutral.
Okay. Would Ms. Prunty or Mr. Curter agree with that? Or is there an effect now that this program is lapsing?
Yeah, the Build America Bond program has, the expiration has hit the end of the year. So I think that the Build America Bond program was helpful in expanding the market for municipal bonds, but it wasn't a direct credit issue for State and local governments.
Okay. Thank you.
With that, I recognize Mr. Walsh.
Thank you, Mr. Chairman. Dr. Biggs, I was going to ask you a few questions about my home state of Illinois, but we've got to vote, so I won't. Let me just ask you one quick big-picture question. It's been suggested by the other side, I think, that government spending cuts, maybe even cutting some public sector jobs at the State and local level, might do some harm to the economy, might do some harm to the private sector economy. Just give me your view. Does that make sense to you?
There's actually been a range of studies that have been done by international organizations like the IMF, the World Bank, the OECD, that have looked at countries that have successfully balanced their budgets. Those, there's some who tried and failed, some who tried and succeeded. The countries that tried to balance their budgets and succeeded in reducing deficits and debt did it principally on the spending side. My guess is around 85% on average spending, only around 15% tax increases. And those countries tended to focus on reductions in transfer spending and reductions in what's called the government wage bill, which is the size and pay of the government workforce. One thing that these studies have found, and there's some debate, but the worst case they found was that these sort of steps tend to be neutral with regard to the economy. Tax increases, they found, tended to hurt the growth of the economy. Some studies have found that these steps could even improve economic growth because of the confidence factor they build in. The individuals and businesses and financial markets see the government getting on top of these tough problems, and even if they're long-term solutions, they feel better today, and that helps get the economy going again.
Great. Thank you. Just one other quick question. Senator Lillenquist, what's one takeaway? What can the rest of the country learn about Utah, if you can bestow one lesson on all of us?
I think the lesson would be that reality is not negotiable. If you can look forward and see what we're bearing as a state, which is what we did on pension problems, it didn't pass the smell test. We looked at every scenario, and that was 95% of the battle as we went person by person in our legislature and sat down with them and showed them the data. We are bearing far more risk than we ever dreamed, and I think that's the message. The reality is not negotiable. You have to do something.
Great. Thank you. Mr. Chairman, I yield back.
I appreciate the gentleman yielding back, and I certainly appreciate the testimony today. Mr. Carter, in particular, thank you for being forthcoming and your analysis. That's very helpful, and we wanted to have that from the credit rating agencies. I appreciate everybody taking the time to be here, to travel to Washington. I know it's not easy to go before a committee like this, but thankfully it was brief in comparison to some other hearings because we've been called to the floor for votes. Certainly appreciate your analysis. This is certainly an ongoing series, and we want to have feedback on what is necessary for us to have accurate transparency and disclosure in the marketplace so that actually those participating, those lending money to states, will have the transparency they need to actually make an accurate decision and price risk. That was obviously the center part of this hearing. We certainly appreciate your testimony. We understand there is a challenge out there, the magnitude of which there has been a little debate, but there is a problem, and we have to tackle that. So thank you for your testimony. And this meeting is now adjourned.
Leadership, these states have grossly underfunded their pension programs. No one has to tell me there is a problem. I am from Illinois. Illinois is one of the worst examples, with a $162 billion unfunded liability. Its pension system is less than 50% underfunded. This level of underfunding is reflected in Illinois' bond rating. In the last 5 years, its bond rating has taken a nosedive. Before it raised taxes, an outcome nobody wanted, its bonds were considered only slightly less risky than Iraq's. Its bond rating is still poor, and that means it is much more expensive for Illinois to borrow money. According to Lawrence Massall of the Civic Federation, bad bond ratings were costing Illinois taxpayers $551 million extra per year in interest payments. States like these need to take common sense steps to shore up their pension systems. Reform is important not only to protect taxpayers, but also to protect the beneficiaries of public sector pensions. These pension systems provide retirement security for millions of government workers, and we have a responsibility to ensure that we are not shortchanging them. Pension reform should restore long-term solvency to pension systems so that workers can depend on a steady retirement income. We can keep defined benefit plans while taking reasonable steps like increasing worker contributions and realigning retirement age, COLAs, and term of service. In some states like Illinois, pension reform will have to go farther than in others. What we have to avoid is a one-size-fits-all approach that doesn't distinguish between the bad apples and the good. And we also have to remember that the onus must be on state governments to reform themselves. One model for troubled states might be the recent series of pension reforms in Massachusetts. Under Governor Deval Patrick, Massachusetts has passed several pension reform packages. Just earlier this year, in January, the Governor proposed 8 reforms that would improve the long-term sustainability of the state's pension system. Officials have estimated that these reforms will save Massachusetts billions of dollars.
This is a meeting of the TARP Financial Services and Bailouts of Public and Private Programs. The hearing is entitled The State and Municipal Debt, the Coming Crisis. At the beginning of this hearing, as I do with all subcommittee hearings, I read the mission statement of the Oversight and Government Reform Committee. So that's what I'll do now. The Oversight Committee mission statement. We exist to secure 2 fundamental principles. First, Americans have a right to know that the money Washington takes from them is well spent. And second, Americans deserve an efficient, effective government that works for them. Our duty on the Oversight and Government Reform Committee is to protect these rights. Our solemn responsibility is to hold government accountable to taxpayers, because taxpayers have a right to know what they get from their government. We will work tirelessly in partnership with citizen watchdogs to deliver the facts to the American people and bring genuine reform to the Federal bureaucracy. This is the mission statement of the Oversight and Government Reform Committee. With that, I'll recognize myself for 5 minutes for an opening statement. This hearing is the second installment of the subcommittee's efforts to examine the causes and severity of fiscal problems facing states and municipalities. Today, we'll explore the magnitude and the growing budget liability of states and municipalities and its origins. From years of unwise fiscal policy to reckless management and collusion between elected officials and the public sector unions, the crisis has emerged as a great expense to the American people. It also has an impact on our markets. It also has an impact on people's savings, especially for retirement. Leading economists have already labeled 2012 as the state's most difficult budget year on record. 44 states and the District of Columbia are now projecting aggregate budget shortfalls totaling $125 billion this year alone, and it only gets worse each year. Even more threatening is the $3.2 trillion in unfunded state pension liabilities and another $383 billion liability for local governments. To be sure, the budget crunch is closely associated with the larger economic stresses facing the country. But years of unchecked spending and overly generous benefits have taken their toll. There are $3 trillion in municipal bonds outstanding across the country, and many state and municipal governments face the real possibility of defaulting on their debt. Ultimately, this hearing is about two things. First is the real debt burden facing states and, may I restate, first, what is the real debt burden facing states and municipalities? And second, what must be done to mitigate the immediate crisis and put these governments back on solvent fiscal paths? But let me restate for the record what I said in Part 1 of this hearing back on February 9th. The era of the bailout is over. Let me repeat, taxpayer bailouts are not on the table. The past 2.5 years of wasteful spending and irresponsible policy under the guise of economic stimulus and emergency economic stabilization have emptied the Treasury of every thin penny. And even if Washington had more money to spread around, a bailout would only serve to delay the coming day of judgment, pushing our children and grandchildren, pushing on them the burden of paying for our irresponsible spending. There must be other options, and this series of hearings is about assessing those options. First, understanding the problem and assessing our options to move forward. Some states are making bold efforts at reform. In 2009, for instance, the State of Utah experienced such massive losses due to the market collapse that taxpayer contributions to government workers' pensions would have to rise to $420 million annually to keep them afloat. Senator Dan Lillenquist, however, successfully championed a plan to reform that will allow the state to remain solvent and enjoy greater budget flexibility. Senator Lillenquist, thank you for being here today. I look forward to your comments.
Over the next 30 years. They are also an important step toward a higher bond rating and lower borrowing cost. On February 8th, the bond buyer reported that Standard & Poor's revised Massachusetts' outlook to positive from stable based on strong management practices. Of course, every state and municipality is different, and pension reform would have to be tailored to each specific situation. Still, the Massachusetts example demonstrates that pension reform can be achieved not only increases bond ratings, but decreases borrowing costs. That also protects workers and guarantees them a steady retirement income. I thank the Chairman, and I yield back.
I thank the Ranking Member, and I certainly appreciate the panel for being here today. Members will have 7 days to submit opening statements for the record, and we'll recognize the panel now. I'll introduce the whole panel, then we'll begin with you, Senator Lillenquist, to give your opening statement. The Honorable Dan Lillenquist is a member of the Utah State Senate. Mr. Robert Kurter, I'm sorry, I'm bouncing around, sorry, is the Managing Director for U.S. State and Regional Ratings at Moody's. Mr. Dean Baker is Co-Director of the Center for Economic and Policy Research Thank you, Mr. Baker. Dr. Baker, I'm sorry. Ms. Robin Prunty is the team leader for state ratings at Standard & Poor's. And Mr. Andrew Biggs is a resident scholar at the American Enterprise Institute for Public Policy Research. It is a policy of the committee that all witnesses be sworn in before they testify. So if you'll please rise and raise your right hand. Do you solemnly swear or affirm that the testimony you are about to give will be the truth, the whole truth, and nothing but the truth? All right. You may be seated. Let the record reflect that all the witnesses answered in the affirmative. Now, in order for us to have time for discussion, at the executive level, governors like Chris Christie of New Jersey and John Kasich of Ohio have begun to push piece-by-piece legislations to reform their pension plans gradually, while still others, like the State of Wisconsin, for instance, have become the proving grounds for the future. Last week, Governor Scott Walker made good on his promise to Wisconsin voters to overhaul the entire structure of public sector unions in the state. That is a bit of controversy, of course. Even the President has commented upon that. Governor Walker's legislation has met with great resistance, but fomenting political chaos will not help to serve or fix this fiscal crisis. The question before us today, they require careful, sober consideration, and it's critical and critically important that Congress examine the state and municipal fiscal crisis and to judiciously evaluate reasonable policy options. Today's witnesses are all experts in that field, and the subcommittee will give them an attentive ear. And with that, I yield for 5 minutes to the ranking member, Mr. Quigley of Illinois.
Thank you, Mr. Chairman. And before I begin, I ask unanimous consent to have a statement from the National Education Association be entered into the record.
Without objection.
Thank you. Mr. Chairman, I'd like to thank you for convening today's hearing, the second hearing on state and municipal debt. I'd also like to thank our 5 witnesses for contributing their time and expertise. In fiscal year 2012, 44 states are projected to have a budget deficit of at least 5%. Although troubling, this is a short-term fiscal problem that has more to do with the current economic downturn than with underfunded pension programs. Once the economy gets going, state revenues will go up and budget deficits will shrink. In the long term, however, we have an accounting problem unique to 6 to 8 states, among them Illinois, California, Ohio, and New Jersey. For years, under both Republican and Democratic